Joshua Tharby back again with some more fantastic tax saving knowledge for you guys. This week we're talking all about group structures, limited company setups, SPVs, the ABCs, you name it, we're talking about it when it comes to setting up your limited company properly and getting the best possible structure that's going to keep your cash in your pocket. Before we do any of that, make sure you hit that like button so I know you guys are loving this content and I know to keep on doing it. And if you haven't already, make sure you have subscribed and you've hit that bell icon so you get notified as soon as I post videos like this. So most importantly, you can start saving tax. Okay, let's get stuck in. So, limited companies, they've become very popular since the tax changes in 2015, 2016, which broadly resulted in a lot of the mortgage interest becoming disallowable for landlords in their own names and in partnerships, and landlords operating through their own names. As a result of this, everybody's moved to limited companies, started setting up limited companies, and have basically completely moved over. They've all put their properties into limited companies, and anyone who's new to property, this seems to be the default way to go about things. However, getting that structure right really is important because a simple off-the-shelf limited company that everyone's setting up isn't going to be the best way for the vast majority of people because there are so many complexities available, such as the group structures we're going to go through later, such as the alphabet shares that are going to help save you income tax now, capital gains tax in the future, and IHT in the future. Having this correct structure really is crucial, and it's important to get it done now rather than later because later on there's going to be tax implications of moving things around. So make sure you watch this video, make sure you study this and watch the whole thing because I've tried to go through as much as possible, but ultimately you've got to sit and watch this in order to get the most of it. Let's go to the whiteboard. Okay guys, so we're at the whiteboard. So here we've got a normal company structure where you've got yourself, and this could be yourself, this could be you plus your wife, your partner. Basically it's usually yourself and somebody else that potentially owns all of your companies. You own 100% shares. You personally, you own the shares in your trading company. Whether that's property trade in your SA, your deal sourcing, any of those, or if you've got a normal trade, you've got a flooring company, an accountancy practice, you've got your trading company there and you own 100% of it. And then what tends to happen is you want to start investing. You want to start investing that money from here because this is a trading company, it's cash flowing positively, it's making excess money each and every month, and you want to start putting it over to there into the investment property to start to put as deposits for developments, mortgages, buy-to-lets, that kind of stuff. So this presents a problem because here we've got two ways we can get the funds out of that trading company. We can loan it from the trading company to the investment company, which is fine in principle, but what actually happens is over time that's going to build up, say 50,000 each year. After 5 years that could easily be £250,000, which might influence the status of that company's trade. So if it's actually determined as a trading company for entrepreneurs relief, business asset disposal relief, potentially even BPR, because it's just got that might actually over time become its biggest asset is that loan. Or what might actually happen is worst case scenario, if that trade dwindles and creditors, liquidation gets involved, that £250,000 asset might be pulled back in. So they're going to try and get that back from the investment company, which can force this investment company potentially to sell some of its properties, very, very worst case, and look to repay that loan back to this trading company. So that's one of the pitfalls of this, and which is why in most circumstances this is not the best structure to have for anybody who's grown a serious business enterprise. So we've got here a much better structure. So you can see you've got yourself at the top and you own the shares. So you own 100 of the shares in your holding company, that group company. And then what happens here is rather than you personally owning the shares in all of your trade and investment companies, we've got that holding company wrapper in place, which is acting as an intermediary. So we now have our trading company, which is owned 100% by that holding company. And this is fantastic because what it allows you to do is, rather than loaning the money between the two companies, we're going to pay a dividend up from the trading company up to the holding company, which is tax-free. Franked investment income it's called. It's tax-free. And then your holding company is then going to loan it back down. Now what this does is it moves the money. There's no loan here from that trading company. So if anything happens in that trading company, there are no issues at the end of the day. That's been paid out as a dividend, perfectly legal. All of these other assets here, completely safe. So that's one of the big benefits of this. Okay, so all of your assets are safe from the trade. There's no risk there. Your holding company, which owns all the assets, owns the trading company, the investment company, anything else, that doesn't trade. The only thing that does is hold those shares. As a result, from a liability point of view, this is basically inert. Nothing happens to this. It does not say boo to a ghost. Okay? And now say, for instance, a couple of years down the line, you've got this structure in place, you're going to sell your trading company. You think, you know what, I've had enough. I want to sell the trading company. Having that structure above, you sell that, you'll have a capital gain at the end of the day. Capital gain, and you'll be able to claim business asset disposal relief up to £1 million limit, and anything over above that, you'll be taxed at 20% most likely. However, because you've got this holding company in place, you're going to get something called SSE. And that stands for the Substantial Shareholders Exemption. So as long as this company here owns more than 10% of this company, which it does, you can sell this for, say, £1 million, 1 million, and your company will get 100% of the proceeds. There's not a penny in tax to pay on that whatsoever. So you sell this, 1 million, that's gone. You've now got 1 million in here, which you can then pump back down into your investments as and when you wish. £1 million cash to then go invest in property and build even further wealth. But the benefits don't just stop there. Also, say for instance you've got different companies, you want to move an asset from your SPV to your investment company, because you're part of a group, 75% or more of the shares are owned, you can move assets around without any capital gains tax, any stamp duty, and also if you're moving assets from capital to being trading, there's potentially no corporation tax as well on moving assets around. So this is a real good way of having a strong structure in place that allows you to scale your business. Say for instance you've got your residential property and your commercial property, you can have them in separate companies, and then when you come to sell your portfolio, you can just sell the whole company. You don't need to worry about selling individual properties. And the way we make this group structure even better is by, with that holding company, that company at the top here, this one here which you own, we don't have just a normal share class, which is what most people do have when they set their limited company up. We have something called smart shares, you might have seen them called, ABC shares, alphabet shares. They've got quite a few names at the moment as they are growing in popularity. It's got many different benefits, mainly when it comes to control, dividends, inheritance tax planning. We're just going to touch on the dividend benefits today. So you've got a normal company, say for instance you wanted to pay £100,000 out in dividends, your husband and wife, you both own 50% of the company, you'll be taxed at £50,000 each. But if your wife, for instance, is a basic rate taxpayer, so she would pay 7.5% on most of those dividends, but you're a higher rate taxpayer, you're paying tax at 32.5% on those 50-50 shares. But what might be a better option is to have alphabet shares, and then you can take any proportion that you wish. So say for instance in this case, A shares would pay out a £90,000 dividend, B shares a £10,000 dividend. Because we've got those alphabet shares, we're able to do that. But if we had it as above, where we've got the normal shares here, it'd be taxed 50-50 each. Unless you get dividend waivers involved, then there's a risk that HMRC are going to challenge those. So in this particular example, the tax saving could be as much as £25,000. These numbers will depend exactly on your personal tax circumstances, but up to £25,000, so it's definitely worth looking at getting the alphabet structure set up, that group structure, get that set up. If you've got current companies, you can move them into it, something called a share-for-share exchange. Definitely have a look at that. But I hope you found this video useful. If you want to see more of my fantastic content, click that video up there, which is my most recent YouTube videos. Otherwise, smash right here to subscribe. Happy watching, guys.